All right, we'll go ahead and get started. Thank you, everyone, for joining us today. My name is Nick Zobel. I'm from Opus Connect, and we're happy to have today's webinar on catching the trends within the consumer sector. We have a great panel for everyone, and we're hoping to have an excellent time. This webinar will take about an hour. We'll save some time at the end for Q&A, so feel free to ask any questions you have. First, on some technical matters, I need everyone, at the top of your screen, there's that green bar. If you put your cursor to that, you will go ahead and see a little drop-down menu. You need to press the chat and Q&A buttons. Your chat window, will be the way you'll communicate with me. If you have any technical issues, just send a message to the host, and I will go ahead and help you. If you can't hear anything like that, you can go ahead and let us know that way. The Q&A function is to ask any questions. You can go ahead and submit those as the event progresses. And David Yarnell, our moderator, will go ahead and take those questions and either ask them during the webinar or he will wait until the end for the Q&A session at the end. So again, it's the chat and Q&A functions at the top of your window. First, a little background on Opus Connect. Opus Connect was founded by Lou Sokolovsky. He's also the founder of Genero Capital Partners. And we have chapters in LA, New York, San Francisco, Chicago, and Orange County. Those chapters hold monthly seminars where we have panels similar to this, just in person. We also have specialty events, which include these webinars, and our Deal Connect speed networking events. Those are exclusive events where we have about 30 firms come together and they get half an hour to meet with each other, get to talk about deals, get to sort of establish connections. It's all membership by invitation only. We have a quality control and we vet every applicant. That's so that we can have intimate, sort of productive events. We have generally anywhere from 35 to 65 attendees at each event on average. And that's, again, so we can make sure that our members get to meet with future deal partners in a more intimate setting. So without further ado, I'll go ahead and hand it off to David Yarnell, today's moderator.
Thank you, Nick. My name is David Yarnell, and I have about 25 years experience in the broad consumer sector, and that's anything from retailing to restaurants, products, e-commerce, media, service companies, travel companies. I've been an operator, a CEO of a company called Mom 365. I ran an apparel company as well. I was at General Mills and Macy's before that. I've been a consultant in the consumer sector for McKinsey for many years, and currently working with a boutique turnaround group as well. I've also been an investor for many years, an operating partner. I'm currently an operating partner at Falconhead Capital, which is a middle market private equity group focused on the consumer sector. Also a general partner at BEV Capital, which is a venture capital group focused on the consumer area and some technology. And before that, I did venture capital at Consumer Venture Partners. And also I'm an advisor to several private equity, middle market private equity firms that focus on the consumer sector. And I've been on many boards, probably about a dozen boards of private companies. Sometimes they become public, all in the consumer sector. So I'm very happy to have this panel here today, and hopefully, you will enjoy the panel as well. I'm going to ask that people email me or press on the question, and I will try to get your questions and answers asked, preferably at the end of the meeting, unless I feel it's necessary to interject at some point. First, I just wanted to get the backgrounds of each of our panelists. Very excited to have this panel. And I'm going to start with Richard Baum.
Thanks, David, and also thanks to Nick and to Opus Connect for putting together this webinar. And I'm delighted to be a panelist here. My firm is called Consumer Growth Partners, and we are a private equity firm with an exclusive focus on investing in retail and what we call non-perishable branded consumer products. We operate as an independent sponsor, and what that means is that unlike traditional funds, we do not have a pool of committed capital. We raise capital on a deal-by-deal basis, almost exclusively from institutional investors and family offices. We have a very extensive network of investors, lenders, executives, and service providers that we turn to in each one of our transactions. We can add significant value to our investors as well as to the companies that we invest in by a pretty detailed level of involvement that begins with due diligence and ends with an exit. We've got 6 portfolio companies at the moment. If you're following along on your computer, you can see them listed. It's a combination of both retail and consumer products companies. We've had our first exit last year, which was the sale of a Western wear retailer called Baskins to a larger strategic that has become the industry consolidator. At the moment, we're looking at a couple of others, and we always are looking to both add to our network of investors as well as continuing to do platform deals. So on this next slide, just a bit about me and my partners. We are almost, in a sense, a virtual private equity firm. I'm in New York. 2 of my partners are in Kansas City, with one of them on the West Coast. And then we've got a 4th individual who works with us, Earl Benson, who is in Atlanta. I guess technically we're the smallest company that can be coast to coast and still have an office in the Midwest. We have a lot of years of experience in both the sectors as well as in investing. My background is, you can see, is principally as a sell-side equity research analyst. My partners are heavily steeped in private equity with a focus on retail and consumer. We founded the firm in 2005, did our first deal in 2007, so we've been operating as an independent sponsor for a number of years. Just to give everyone a sense of what we look for when we are investing, we don't do startups, so we're looking for companies that have at least a couple of $1 million of EBITDA. We look to invest anywhere from 5 to generally 25 million. I think our average investment is something in the 10 to $15 million category. We've got a number of very specific criteria. Like everybody else, we're looking for a defensible business model. I'll talk a little bit about that later. An experienced management team, although we're not opposed to inserting a new CEO if that is a requirement. We do look for proven economics, and that means in the case of consumer, something that has been perhaps very successful on a regional basis and is now right to go national. We focus on EBITDA growth potential as opposed to revenue. We're much more interested in profits than the level of sales, and we like to make sure we've got some sort of viable exit on the other end as we go in. And we are happy to do either control or minority investments.
Okay, it's Alex Chefetz now from BTIG. I appreciate David being invited and Opus as well. If everyone's looking at the slide that says BTIG Global Share Volume, I'll tell you a little bit about BTIG. It's about 10 years old. The firm was founded by a group of folks that had built Spearlead's Kellogg and had sold that to Goldman Sachs in 2000 for $6.5 billion. Worked at Goldman for a couple of years and then started BTIG. Over the last 10 years, we've grown from 5 people to 500 people. We have 10 offices in the U.S. and 4 offices internationally. We're focused exclusively on the institutional marketplace and not retail investors, but institutional investors. And our biggest business is equity trading. We are the 8th largest U.S. Equity trading firm and the 16th largest equity trading firm globally. If you flip to the next page, you'll see on the investment banking side a number of transactions we were involved in, 65 last year and 20 so far this year. These are all public financings ranging in size from $3 million to $700 million. fairly opportunistic in terms of sector and size, and it cuts across all industries. If you flip to the next page, you'll see the types of products we offer and the types of capital raising that we do. On the product side, on investment banking, we do everything from IPOs to convertibles to M&A advisory work. Our hottest products right now are what I would call ATMs, which is an at-the-market offering. It's sort of the flip side of a share repurchase program that allows companies publicly under a shelf to sell stock at a price that they want on a day that they want and report it quarterly. It's a relatively new technology, but it's about 20% of the market right now, and I think will be 50% of the market in the future. We do pipes and registered directs as well, so while I work with a lot of private companies, I also work with a lot of public companies, and there are a lot of public companies that should be private, and so the lines between those kinds of companies are blurring. In terms of what we raise money for, it's growth capital, acquisitions, recaps, dividends, stock buybacks, and it can be as neutral as general corporate purposes. My specific background on the next page, I have over 20 years of experience, most of it at Smith Barney, which turned into Citigroup, and a number of years at Thomas Weisel Partners, which we eventually took public and sold to Stifel. My background spans across all sectors of consumer, from e-commerce on the left to consumer products on the right. We have the word 1212 here, which is a mistake. It must be a code for consumer products, but I've done work in restaurants, hard lines, soft lines. The common denominator is all of these are strong brands, or were at the time that I worked with them, and had loyal consumer following. So I see more commonalities between this group than differences, but I've had a really fun time working with growth-oriented consumer companies over the last 20 years. Thank you.
Thank you, Alex. Lisle?
Great. Thank you so much. I'm Lisle Davies. My firm is Davies & Co. I'm based in New York City. We're an advisory firm. We work with consumer brands, retailers, private equity, and other investors in areas related to strategy. Comprehensive offerings around market research and analysis, consumer insights, both qualitative and quantitative, competitive intelligence, all kinds of strategies from brand positioning to growth strategy, market entry, et cetera. Detailed and expert store audits, have category expertise in several key categories, as well as provide due diligence support. The firm brings to bear best-of-breed teams to optimally address clients' challenges on a project-by-project basis, and we specialize in identifying key business issues to be tested through research. My personal background, I have 25 years of experience in the consumer and retail industry. I've advised clients across a range of strategic issues. I work at senior management and board of director level, as well as with investor partners to develop growth strategies for both private and public companies. I've worked across a range of price points, across categories, and across size of businesses. I've worked with quite a number of private equity firms conducting comprehensive due diligence assignments to identify growth, profit opportunities, risk factors, et cetera. Prior to running Davies & Co., I was a partner at a boutique retail practice called the Grayson Company for 11 years. Prior to that, I spent 8 years at PricewaterhouseCoopers in their retail consulting practice, and prior to that, I began my career in the training program at Macy's and have an MBA from Columbia as well as a BA from Tufts.
Thank you, Lisle. And Sabrina.
Great. Good morning or good afternoon, depending on where in the country you're in. My name is Sabrina Merage. I work with Consolidated Investment Group, which is my family office based in Denver. CIG was founded after the sale of our family-owned business, which was a frozen food manufacturing company called Chef America. Chef America was best known for products like Hot Pockets, which was founded in the mid-'70s by my father and my uncle. That company was sold to Nestle in 2002. Since then, CIG's been investing in a number of platforms. Nick, you can go to the next page. So just a little bit of background on the family office. We have three main platforms: the real estate investment arm, capital markets, which is where we also house our private equity direct investments, which is currently investing in a number of funds or whatnot, and public equities. But my focus is on acquisitions of food manufacturing companies. So today, 12 years after the sale of our business, we're going full circle back into the food industry, into an industry that we know very well. It's fitting not only because of our background and expertise in that field, Chef America at the time being the fastest growing food company in the country, and also one of the most successful exits to date. But we have kept on a number of our core team from Chef America on with us at BTIG, so a lot of that expertise and experience remains. So we are now looking to build our portfolio of food manufacturing brands. And then our family foundations, which is 4 family foundations that are housed in our family office. Just to get a little bit more in depth, next slide, thanks. A little more in depth in our private equity direct investment division, we are looking at companies exclusively in food and beverage, what we know best, up to $5 million of EBITDA. We're looking to invest, I would say, this says $5 to $20 million of capital, but I would say it's actually more like up to 30. We are looking for majority ownership, preferably full buyouts. Generally what we're seeing are the companies that are family-owned businesses that either don't have a succession plan, they are, looking to exit for estate planning purposes, or perhaps they just don't have the resources or expertise to scale nationally. Those are opportunities that work really well for us, as we're able to then bring our experienced team in and take over the business and help it grow. We have a shared services platform, which is pretty unique to our business, where we are leveraging not only our expertise in-house, but also a number of our resources that we have. The family office is pretty large in scale. We have about 40 people in our Denver office. I'm actually based in Los Angeles. I have a colleague also in San Francisco, but the bulk of our team is in Denver. They work in different aspects of our business. We also have the support team in HR, legal, accounting, and finance, and so on. And we're able to leverage those resources out to our portfolio companies as well. So that's really the background on that. I also wanted to touch very briefly on a new fund that is working in parallel with our direct investment company. This is Echo Capital Group. It is an earlier stage venture investment company where we're looking at making early stage growth capital injections in consumer product companies, so not necessarily focused exclusively on food and beverage with this one, but smaller investments in earlier stage consumer product companies. The differentiating factor with this one is we're really looking at companies that are founded by young and driven entrepreneurs who are creating consumer products for the ever-growing millennial demographic, and I know we're going to get into that a little more, especially millennials as consumers, and the differentiating factor there. So I just wanted to touch on that very briefly, and that's it. Thank you.
Great. Thank you, Sabrina. What I've asked each of the panelists to do is I've asked them a question about consumer trends in each of their areas of focus. And I'm going to start with Lisle, because Lisle, you've advised and consulted for many consumer businesses of all types. My question to you is, what do you see as the key overall trends impacting consumers today?
Thank you. So in terms of key consumer trends, I'll try to keep this at a high level because I know we'll be discussing it more later. But the first one that I'm seeing, and I'm sure everyone is seeing, is in the area of health, wellness, fitness, beauty, and not to say that younger consumers are not interested in this, but this has really been being driven by older consumers. You know, people want to live longer and be healthier and look good essentially forever. So this ties to everything from what they put into their bodies, so food and supplements, and I know we'll talk specifically about that later, to fitness, their exercise routine, general psychological and physical well-being, as well as their physical appearance. So anything from skincare to injectables, other cosmeceutical type products. So that's one sort of larger general trend. The second trend I'm seeing is this idea of the sharing economy, and this is really being driven by younger consumers, and we'll talk a bit later about millennials specifically and what's important to millennials and all the sort of psychographic and cultural things that go along with millennials are driving what's being called the sharing economy, which is basically that younger people are preferring experiences and renting or sharing versus owning products. So companies such as Rent the Runway, Airbnb, which is, you know, a replacement for hotels, Uber, which is car service, et cetera. Social media is increasingly prevalent and becoming increasingly important from a marketing perspective and ensuring consumer stickiness perspective. And the last kind of major trend is really the consumer's in the driver's seat now. And for a long time, retailers and brands could put things in the forefront and consumers would react or not react. But now consumers are really driving things and forcing brands and retailers to react. You know, information is now complete. Prices are completely accessible to consumers. Consumers, you know what things cost, know where they can get things more cheaply, and retailers and consumer brands in general are forced to be more creative. And part of the consumer being in the driver's seat is also driving convenience, the need for convenience, which encompasses a lot of things. It can encompass overnight shipping. It encompasses multi-channel, which really means be where the consumer wants you to be, when she wants you to be there. Anything from online to stores to mobile, et cetera.
Thank you, Lisle. And I'm going to now turn to our investment banker on the panel, Alex. You have seen and worked with many consumer company transactions. What are you seeing in terms of the key trends in these consumer transactions?
Okay, great. Thanks, David. IPOs, well, I broke my presentation into IPOs, financings, and M&A. So on page 22 here, you'll see IPOs. Rumored deals at the top of the page. Alibaba has picked up a lot of steam recently, and they're talking about filing that potentially Monday or Tuesday of next week. I mean, the theme there is size, you know, really the Amazon of China. They've gotten so confident in this IPO that it looks like they'll be selling shareholders at the time of the IPO as well. Chobani is the other one that I think is going to be really interesting to see how that turns out. Obviously, the Greek yogurt trend, going back to the earlier comments on health and wellness, and we could have the debate on Greek yogurt, but that trend clearly, I think, peaked probably 2 years ago, but this brand has now gotten over $1 billion in revenues, and I think we'll get a very big valuation in the IPO marketplace. Obviously, they're doing a lot of advertising as well, which never hurts an IPO. Wayfair is an online business. The other name that's been talked about recently is J.Crew, which was public, then taken private. It looks like we'll be going public again. So I think some of the themes here are e-commerce, and when you say e-commerce, you better be having a very strong growth rate, and by strong, I mean more than 30%, ideally probably closer to 50% growth. And the more growth you have, the less profit you need. So if you have 100% growth, you may not need to make money, or at least near-term make money. Companies like Zulily, which went public at the earlier part of this year, have a multi-billion-dollar valuation on a flash sale business that at the time it went public wasn't making money. Coupons.com is also on this list. Grubhub, which was a merger between Seamless and Grubhub, also an e-commerce business. On the flip side of that would be restaurants. still continue to be a very hot sector. Zoe's Kitchen doubled on day one of its IPO and now has 111 locations and a market cap close to $300 million, so if you think about value per restaurant. And I also think it's interesting to see Sears spinning off Land's End, which is clearly the growth vehicle within their portfolio. Flipping to the next page on financings, and by this I mean sort of public companies mostly doing what I call desperation financing, and it's mostly in the bricks and mortar world. It's mostly in the tween retailing sector. Companies like Delia's, Coldwater Creek, you could add Cache, Body Central, all really desperately looking for what I would call financing to stay alive, and maybe there's a better word for that. They're doing what I call desperation pipes, death spiral converts, mostly with hedge funds, mostly to buy time, mostly to find traffic, which again I think is an elusive topic, or to reposition the business, to grow their direct business, their e-commerce business, and I don't know if they'll have enough time to do that. On the private company side, I have Patsy's Pizza, and I see very few deals getting done on what I would call the minority growth side of private company VC raising. I think it's a very tricky business to be in as an agent, and there just aren't that many VCs and private equity firms that will take a minority position in a growth vehicle today, despite the high valuations in the public marketplace, just because you don't know by the time you're ready to public whether the market will be there. M&A side is really where most of the action is happening, and I have 2 pages of deals here. We've seen a lot in the food area, with Vans getting bought by Hilscher Brand. This frozen business was mentioned earlier by one of our other panelists. You saw specialty brands get bought by B&G Foods as well, all of what I would call safe bets. And then you're seeing other interesting deals on the consumer health side, Prestige Brands at the top of this page buying Insight, which was potentially an IPO in and of itself, paid close to $800 million for this company. There's an NOL involved as well. I would probably call it an 8 to 10 times EBITDA buyout, but I don't have that exact number. I think very interesting, if you flip to the next page, you'll see a couple of other interesting deals. Brookstone coming out of bankruptcy, and you'll see DFC Global, which is a check cashing business, actually took a fairly low buyout from Lone Star Funds that I think will be challenged. Piccadilly also coming out of bankruptcy, Sbarro going into bankruptcy. And so that's the other end of the spectrum, is we all want to talk about the high-flying IPOs, but I do think there are some good buys as well in the bankruptcy business and a whole set of mostly private equity groups that go after that market. The other strategic player out there, Essilor, which is a big French eyewear company, made 2 acquisitions recently, Coastal Contacts out of Canada for a big price, and Costa, which was the old A.T. Cross. A.T. Cross, public company, sold its pens business to Clarion, private equity firm, changed the name of the company to Costa Eyewear, which was really their growth vehicle, then ended up selling that to Essilor, also for a big price, in my opinion. So that's the quick, I would say, again, most of the activity, I'm spending more than half my time on the M&A side, kind of a quarter on the IPO side, and a quarter of my time on the financing side.
Thank you, Alex. And now I'm going to turn to our 2 investor groups on the panel, and the good thing is they don't overlap. So, Richard, you concentrate on consumer service and non-perishable product companies. Tell us a little bit about what you see as the key trends and opportunities in your areas.
Great, thanks, David. So let me just spend a second here on non-perishable, just so we can be clear about what it is from our perspective. So we really look at 3 buckets. One we call soft lines, very traditional industry term, simply meant to describe things you can wear. Hard lines, things you can't wear, and then what we call no lines, and those are companies that are either yield or capacity based and would be things like fitness centers and movie theaters and clinics and the like. You're going to hear, I think, a lot of overlap amongst all the panelists in terms of what the consumer trends are. Frankly, they're not too secret anymore, and we're all looking at more or less a number of the same ones. So not surprisingly, Lisle and I have the same one at the top of the list, health, wellness, and fitness. You know, the kinds of things that we see going on here range from fitness clubs to yoga accessories in a big way, both apparel and non-apparel, personal fitness equipment, which can be things like treadmills and bikes and boards and skates and just about any way you can seriously injure yourself. And then on the back end, things like health clinics, which, you know, after you've injured yourself, you can go to get cured or fixed. Secondly, mobile devices and accessories, obviously still exploding market on both the devices and the accessories side. Growth having slowed down a lot because saturation levels are getting increasingly higher. Number three, what we have called, if you call it kind of out of home or away from home destination types of businesses, hospitality, resort, and travel, there's certainly been a number of websites and internet sites that really focus on the travel space. We have a business called Cellars that's in the wine area and is now, interestingly, about to combine kind of wine and food and have an equal emphasis on both. Our wines are very highly rated, and we think it's an interesting niche to both combine wineries and food in a way that hasn't been done before. And then fourth would be on the leisure and recreation side, more at-home types of businesses or near home. So we've seen a number of a lot of amateur team sports. Team sports has become very significant. A company recently that was bought and is growing rapidly called Academy. Lots of several kind of game set companies, and there's a company that's in the marketplace now called Marbles that emphasizes kind of brain development games and activities, which I think probably all of us could use a steady dose of. Things like spas and hot tubs and whatnot. Lastly, an area that we actually spend a lot of time on, we'll call it consumer aspirational purchases, but the kinds of things that we're seeing in more traditional product categories, you know, really fall into a few different segments. There's a lot of personal care products. Lisle put that in the health, wellness, and fitness, and I certainly wouldn't argue with that. On apparel, footwear, fashion accessories, we still spend a lot of time on trying to find interesting consumer brands and where the value is in the brand and it can continue to grow rapidly. I think an excellent example of someone who's done this recently is Warby Parker, which is in the eyeglass business, become a very hot business with lots of capital going into it. Started out as just web only and now starting to open some freestanding stores as well. Next slide. So we have, let me go through these quickly. I'm not going to spend time on them. But things that have been mentioned as consumer trends, we would kind of talk about as strategic considerations, things that you absolutely have to do today to be successful regardless of what business you're investing in. So these aren't quote unquote purely investable categories, but things that you need to do to be able to be successful. We can talk about more of them later. And then lastly, just a couple of investment targets that we like to look at regardless of product category, and they fall into really two segments. One are later stage businesses in transition, where it's a founder, a family business, and they've gone about as far as they can. And then early stage businesses where the managements are young and dynamic, but the infrastructure needs a lot of enhancement. You don't want to make sure you outgrow it, and those businesses that can benefit from a lot of outside expertise.
Great. Thank you, Richard. And I wanted to go to Sabrina. As an investor in food and beverage, what do you see as some of the key trends and opportunities in your area? And we'll go in heavy detail a little bit later, but overall, what are some of the key trends?
Sure. So some of the same things that you're hearing over and over again, that healthy food, better for you. In the beverage sector, we're seeing a lot of natural beverages, coconut water, even natural energy or naturally sweetened beverages like with stevia and kombucha, which I think was a surprise for a lot of people to see how it's expanded. In the fresh grab and go and prepared food sector, we're really seeing that it's very demographic focused. So grab and go is doing very well, and even convenience stores like Duane Reade's are now selling, fresh grab and go products and sushi, especially in places like New York City for those of you New York folks. And all natural, organic, non-GMO, kosher. I put slippery slope term next to all natural. I'm not sure how many of you know that there have been a lot of food companies that have been targeted by actually a group of attorneys that have made it their business to sue food companies that are claiming all natural on their packaging when it may not be all natural. It's also a little bit of an ambiguous term. It's not well defined, like a certified organic or certified non-GMO products might be. An example of this would be products that have baking soda, for instance. Baking soda by definition is not a natural ingredient, so that's a little bit of a concern. But in general, those are products that we're seeing doing very well and expanding. I added the kosher in there because, interestingly enough, kosher is now becoming kind of the new organic or new healthy definition for foods. People see the kosher stamp more and more, and they're saying, okay, I trust this because it has to go through a much more intensive process. And then healthy snack and savory snack. These are, again, the on-the-go, the convenience, the able to grab and go. Healthy cooking at home, this is something that is kind of going back to a few decades ago, honestly. We're wanting not only cooking kits that are convenient but healthy and transparent ingredients. Farm-to-table and organic delivery programs are really helping out with that, cutting out the middleman so you know exactly what you're getting, what you're eating. And consumers creating relationships directly with farmers and growers. And then ethnic, I think this is something that is very unique to the younger demographic with more sophisticated taste palettes. Hispanic, Asian, and fusion foods are really doing well, and that also obviously has to do with the growing ethnic populations in this country. Superfoods, I think, is something that we're seeing a lot of. The quinoas, acai, hemp, protein, kale. These are now terms that we're seeing on menus in restaurants, and also superfoods and packaged foods are getting a lot of attention these days. Positioning for a younger consumer demographic is essential. That's something that we, again, will talk about in a little bit, but it's really important that you're able to reach out to the largest and growing demographic of consumers today. And then food and technology merge. This is really important and also has to do with millennial consumers. Nearly half of shoppers will actually completely abandon a retail brand altogether if they have a poor mobile shopping experience. So that's one example of something we're seeing in the food and technology merging. I wanted to talk a little bit about the challenges that we're seeing. Being able to identify between long-term trends and fads. This is really my job, right? I live in Los Angeles, but I'm trying to identify brands and companies that are scalable nationally. An example of this would be that Los Angeles residents are 46% more likely to order from restaurants offering healthier options than the rest of the country, but people experiencing financial dissatisfaction choose more caloric foods and consume larger amounts of food. So you have to really be able to know who your audience is and develop a relationship and cater to that. Trends that are nationally scalable versus niche and selective trends. This is something that, it really depends what you're investing in or what you're interested in as a consumer. Some of the coastal cities are really going for kombucha, and I would venture a guess to say that kombucha is not doing so well in middle America right now. Product labeling challenges, that goes back to what I mentioned about all natural. Staying ahead of the curve, what young consumers want, and also the fact that, frankly, all of the panelists have kind of identified some of the similar trends, and it's not a secret anymore. It means that it's highly saturated. So being able to identify where you can really provide value, where are the trends that we think are scalable, but are also we can create an impact. And then, frankly, it means more expensive consumer options and more labor-intensive for the manufacturer, the fresh, grab-and-go, and the non-GMO options, so that's something to keep in mind. And finally, the shifting sales channels. I won't touch on that too much, but something for the retailers or the people who are investing in food and interested in food products. The way that we purchase foods and where we go as consumers is different than it was 10 years ago. So that's something to keep in mind as well.
Thank you, Sabrina. And now we're going to talk a little bit about, we're going to go back to retailing and just talk a little bit about, who are the winners and who are the losers. So a little bit more about how do you choose between, with all these trends, how do you figure out which one's the one that you back? So we're going to start with Lisle, and then I'm going to ask Alex and Richard to comment.
Thank you. So in terms of the winners, I mean, the winners are obviously going to be in tune with one or more of the trends that are going on. And from a product perspective, great product is still king for many consumers. So, Warby Parker was mentioned earlier, and Warby Parker was the first one to present fashion eyewear at a price. So they offered great products, a strong price value that the consumer valued. They started as this kind of quirky, interesting online business, and they've created this nice multi-channel strategy that kind of fits in with their heritage as the brand. So that's one example, I think, of a winning formula. Also, the retailer that's going to get the social media piece of things right will really win, because the social media is really transitioning what's happening in the marketing world. Consumers, through consumer research that I've done at my firm and done at previous firms and have read, everywhere, the number one thing that will get a consumer into a new brand is referral by a friend. And referral by a friend has gone from traditional word of mouth to word of mouth through social media. So the brands and the retailers that can get that piece of it right will really be will really win. So A, to get the engagement, and B, to get the stickiness.
Great, thanks, Lisle. And Alex, what about what retailers are winning and which ones are losing?
Well, I think, if you talk about soft lines, it's clearly fast fashion, disposable fashion, Forever 21, H&M are the ones winning. But just saying the category doesn't mean everybody's going to win. So you look at companies like Rue 21 and Dots, and you wonder whether they're going in the right direction or not. I'd probably say no. In hard lines, which I think is actually the more interesting area to be in, which is a conglomerations of lots of different little sectors, home furnishings, I think, is less competitive, more opportunity to invest, better valuations, less fickle. So I spend most of my time in that. And then you have companies like Williams-Sonoma, Restoration Hardware, which has risen out of the ashes to become a great company. A company like Container Store, dominant in its category, arguably created the category. It always comes down to management, and that sounds kind of corny, but that's typically what, it doesn't mean it has to be a proven management team, it just has to be a good management team. And a good management team is an authentic management team that believes in their product and knows who their customer is. And I would say marketing to an 18-year-old woman is very complicated. Marketing to people that are refurnishing their homes, which could be anybody from 25 to 65, is broader and a little bit more reliable. So I'm not sure if I'm answering your question, but it's a lot of the comments that were just mentioned about brand loyalty and reaching your customer, but I think it comes down to how competitive your category is, can you reinvent it, are you omni-channel, and that omni-channel means, in my mind, at least half and half between online and bricks and mortar, and you know, and how clear is who your customer is.
Great. Thanks. And Richard, just a comment or two on winners and losers in retail?
Sure. I think the way we look at it, David, is, you know, rather than specific companies, some really important characteristics, a number of which have been mentioned, so I won't dwell on them in detail. But number one, you know, is a company that's got a defensible niche, and that means that you are not going to be outcompeted or put out of business by a company that is larger and better capitalized than you. So we do look for little niche businesses. Second is that companies need to be properly capitalized, and in the middle market, you know, oftentimes we see companies that even after they raise their money, they're undercapitalized and behind the eight ball from the beginning. This management team is all important because it does, A, make the job easier because you know what you're doing, and B, usually better in touch with the customer. Four, I would say focused management team that is not engaging in too many initiatives. Oftentimes we see management teams are trying to do too many things with too little money, and the results tend to be disastrous. And then lastly, which has been mentioned, in touch with your customer. What do they want? How do they want to buy it? It goes to social media, it goes to omni-channel, and I think soon to come goes to big data available to smaller companies on a cost-efficient basis that will better help them understand their consumers.
Great. Thank you very much, Richard.
David, just one thing that I think needs to be added on the loser side, especially when we're speaking about retail. So we've talked about undifferentiated, which obviously makes tons of sense, but we also need to talk about retailers who have too much square footage overall, too many stores, and then stores that are too big. And that's more and more of an issue as we move more and more to sort of creative omni-channel type models and less, you know, mall-based kind of retailing.
Great. Good point. Okay, each of you mentioned the influence of younger consumers, the millennials. And I'm going to start with Sabrina because you actually have a fund that focuses on this area. But how is this demographic impacting the market? And who might be some of the winners and losers and, you know, in catering to this demographic?
Sure. So before you talk about the trends in the millennial demographic, one of the things you should do is try and understand a few of their ideologies first. First and foremost being that millennials ages kind of 18 to 35 are really rejecting a lot of their parents' ideals and labels and a lot of the, you know, regarding gender and identity, all of those things are kind of blending together. And that's how they pursue their consumer purchases as well. So things that are specifically targeted to one gender or one race or one, you know, age group doesn't really work as well with this demographic because all of those things are blurring. So now a few things that millennials really care about. They are incredibly technology savvy. Advertising on smartphones, purchasing through technology, making more informed decisions based on research and topics that are trending on social media. These are all things that are influencing their consumer purchases. They require convenience and on-the-go portability. I touched on that a little bit in the food. I would venture a guess that this would apply also for broader consumer purchases. Very health-conscious shoppers, really looking for simple and transparent ingredients. And teenagers are, well, so on that note, millennials are known for spending a premium on the health-conscious or healthier products, and that also is shifting consumer palates. Consumer palates in this millennial demographic tend to be more sophisticated tastes, ethnic, fusion. They'll pay a premium for that as well. Teenagers are now shopping as much in food as they are, and if not more on food as they are on clothing. One major trend in the millennials is that they're merging social impact with everyday consumer purchases. They're really wanting to blend their philanthropic and social impact ideals with everyday consumer purchases, which is why companies like Tom's has been doing so well. This idea of buy one, donate one. Kroger actually rolled out with a nationwide rewards program recently where consumers could choose which charities their money would be sent to based on their in-store purchases. So those are a few different things. Also, generally moving away from large corporate and institutional fields. They really like local, active, peer-to-peer. McDonald's last year said that they lost, their consumer base declined by 2%. And the reason for that being that they've lost customer relevance. So these are all trends that are very specific to the millennial demographic. Companies that acknowledge that the millennials are the largest demographic and soon to have the most buying power really need to understand the ideologies, the trends, and what direction that they're headed in. Just creating marketing campaigns for a younger demographic doesn't necessarily mean that you're appealing to their purchasing habits.
Great. Thanks, Sabrina. It's definitely a challenge. They tend to look a lot before they buy, if they buy at all at times. Let's talk about valuations of consumer deals. And Alex, maybe you could just talk a little bit about what you're seeing for valuations, and then we're going to ask Richard about the private equity side as well.
Sure. I think valuations have never been more separated in terms of the have and have-nots. I mean, it depends on which sector you're in, but even food, which I would consider food and beverage to be a fairly traditional sector. Healthy and natural companies with good growth rates are getting revenue multiples, which is something we probably weren't talking about 10 years ago. I think of a company like Food Should Taste Good, which arguably went for close to 3 times to a large strategic buyer. On the e-commerce side is probably the most exaggerated form of that, where you're seeing companies go public at 10 times revenue and they don't make any money. So we're really talking about revenue multiples when it comes to e-commerce. And it's really either have this great growth and great loyal customer base and great brand, and you get this 10x revenue multiple, or you don't. So companies like Zulily trade at more than 10 times revenues. Companies like Shoe Dazzle, which the growth rates slowed down and they continue to lose more and more money, end up going for less than 1 times revenue. So it's wide gap there. Soft lines, again, I think there's been multiple compression on EBITDA because it's gotten so competitive and traffic is down across the board. I do think in hard lines, in home furnishings, multiples have held up nicely. Restaurants, I think, are at a high in terms of EBITDA valuations, especially for growth concepts and especially ones with healthy feel to them. So you're seeing 8 to 12 times EBITDA for restaurant companies. And consumer products is the last piece I would add, particularly in personal care, beauty, and cosmetics. You're seeing very high valuations as well. Unfortunately, there you only have a few real big strategic buyers, Estée, Coty, L'Oreal, but those companies that can attract those big three are getting very healthy double-digit EBITDA multiples.
Great. Thanks, Alex. Richard, what are you seeing on private equity deals?
So we're, I guess, a bit old-fashioned in this regard. As soon as we see something trading as a multiple of revenue, that's probably the fastest race that we can run away from. So we really focus on EBITDA growth and growth rates to try to figure out what's a fair multiple. And we know that they move around a lot, but it's a general proposition, David. Things that are growing their profits at less than 10%, trade at less than 5 times EBITDA. Things that are growing, let's call it a 10 to 15% range, we think a fair multiple is 5 to 7 times. And for really high growth companies, and those are companies, you know, in our universe growing EBITDA or profits at more than 15%, depending on how fast they're growing, can range from 7 times all the way up into double digits. On a long-term sustainable basis, I think if you look at the public companies, the number of companies that have grown their profits at 15% or greater for, you know, more than 5 or 10 years in a row is like 2 or 3. It's actually quite low. So we tend to focus on that. And usually, you know, there's probably some correlation with products. As Alex pointed out, you know, those that are not growing rapidly, older products, again, lower multiples, newer products, higher multiples, things that are relatively new but have a lot of opportunity to grow, probably in this mid 5 to 7 range.
Great. Nick, do you want to explain the Q&A part?
Sure, absolutely. So again, if you are logged in on your computer, you should put your cursor at the top of your screen. The drop-down menu will pop down just like on the slide. Just press Q&A, and you can type in your question there, and Dave will go ahead and ask it. We have a few minutes, so we'll try to get in 1, maybe 2 questions briefly for our panelists, and then we should be good to go.
Yeah. And while we're waiting, I'm going to ask the panelists just one quick question, and maybe I'll start with Richard. What would you say, what has surprised you most about investing in the consumer sector?
I think it was the point that I made at the outset of my last comment, that it always amazes me that companies who aren't making money can trade at some huge multiple of revenue, and eventually you get proved out. But from my days as an equity research analyst, you know, it would take years for some of these companies to actually justify their valuations, and by and large, most of them never do. But God bless, there are people out there that think that hope springs eternal, and we'll get it back.
You need to get in and out fast on those deals.
Those are called flippers. Yeah, we might consider those.
What about Sabrina? What about you? What has surprised you the most?
You know, it's actually funny what Richard said. We agree wholeheartedly. One of the things that we're seeing being a family office is that we're competing to deploy capital with some of the big PE firms or institutional investors that are sitting on a lot of dry powder and need to deploy within a set period of time. As a family office, we don't have those restrictions. That being said, we still find opportunities that we are interested in, and we still have our own, you know, set criteria for deploying capital every year, and also the number of opportunities that we want to bring under our belt every year. When we are seeing multiples of revenue, we just really shy away from that. And also when we're seeing companies that are valued at what I would say the valuation expectations between buyers and sellers today has never been more of a gap than I've ever seen it. And that's a big challenge for us to really deploy capital in a way where we think it's smart money and a smart investment and a long-term opportunity. You know, we also don't, we would very much be open to the idea of a quick turnaround, but we don't have those kinds of restrictions. So the opportunities that we invest in, if we need to sit on it for a little while, we'll sit on it. You know, we're looking at whatever's best for all parties involved. But the valuations right now are a really interesting challenge.
Okay, Nick, I know we need to, there was one question. Do I have time for one other question or no?
Sure, briefly.
Okay, because we have a question from somebody out in the audience, and they were asking about valuation changes by round, seed, A, you know, B rounds, and maybe I'll ask the panelists, maybe Richard, maybe you're closest to this, but what are the kind of valuation changes you're seeing by the different round series?
Yeah, well, I think, you know, I mean, I would say that certainly the earlier rounds are done at higher valuations. As a company kind of proves out the concept, you know, you'd expect them to be more reasonable over time. But what we're, you know, this is really more in the area of venture capital, and perhaps it's important to make the distinction between venture capital and private equity, because as Sabrina mentioned, we got to look for proven concepts. So we're not really in the seed business or even some of the A rounds. So they generally tend to be in these sectors, retail and consumer. There's really kind of not very much venture capital money, and if you require some level of profit, you're just going to probably not ever get there.
Yeah, I mean, I find it's mostly family offices and angels that is investing in the seed and A rounds in the consumers.
Yeah, also high net worth individuals.
Yeah, exactly.
And
well.
David, if I can speak to that, because ECHO is a venture capital fund in the consumer space, and we're looking, it was an interesting shift for us going from BTIG, which is looking at later stage full buyouts, to ECHO, which is really the earlier Series A round. The valuations at that stage are a lot higher. It's always a multiple of revenue. There is no EBITDA at that stage. Series A, we're seeing sometimes 11, 12 times sales, which blew my mind, honestly. But it's a riskier investment, a riskier proposition, but valuations are certainly from an earlier stage much higher than, the later stage businesses.
Okay. I think we need to wrap up, right, Nick?
Yeah.
Okay. Do you have any parting comments you want to make, Nick? Or?
Yeah, absolutely. First off, thank you to everyone who... Oh, go ahead.
Let me just thank my panel, if it's okay with you. Thank you, panel, very much. You were great in providing some great insights into the challenging area of investing in the consumer sector. And Nick, I'll let you finish up.
Absolutely. I'd just like to echo David's thoughts again. Thank you to our panel. Thank you to David for helping us set this up. And thank you to all of our attendees for attending today. Just a few quick notes. When you log off, you will receive a survey. Please go ahead and fill that out just so that we can know how we did, what you'd like to see in the future. This is a model that we're hoping to have long-term, so we'd like to definitely have the type of panels that you'd like to hear. You'll also be receiving an email in about an hour with contact information for our panel. So if you have a question you weren't able to ask, or if you want to get in touch with them, you can go ahead and use that information. In a few days, probably early next week, about Tuesday, you'll receive a link to a recording of today's webinar. That's something you can share, distribute with anyone if you'd like to rewatch this event, or share it with anyone else. If you have any questions about Opus Connect, you can go ahead and contact me. My email address is right there on the page, and you'll receive emails with that as well. And again, qualified potential members can attend 2 of our in-person meetings, depending on if you're in the area. Just get in contact with me or anyone else at Opus Connect, and we'll go ahead and start chatting with you and see if we can set up events where you can come and attend. Thank you again to our panel and to our attendees for attending today, and we hope to see you all at the next webinar.
Thank you.